Hello, everyone. I'm Chris Sullivan. I'll be your host for the latest installment in our Swiss Re Corporate Solutions webinar series. Today, we're going to hear from my colleague, Todd Chima, on the topic of MYSLs, which are multi-year single-line covers. Todd is a senior structurer in our Innovative Risk Solutions team and has extensive experience structuring alternative risk solutions for our brokers and clients. Before we get started, a few logistical reminders. One, you're muted. Please feel free to submit questions throughout. You'll see a question box on the screen, and we'll get to those at the end of the presentation. And if you encounter any technical issues, press Control plus F5 to refresh. Now, without further ado, I'll turn it over to Todd Chima. Todd?
Thank you, Chris. Thank you for joining today. Thanks for taking time out of your busy schedules to attend our presentation on MYSLs. So a little background first. I know Chris has introduced me, but I'll give you a little more information. I've been with Swiss Re for about 15 years, the last 5 on the Innovative Risk Solutions team. And our team uses techniques other than traditional insurance and reinsurance to provide corporates, captives, and public entities with solutions. And again, these solutions that we provide are not typically found in the traditional marketplace. As Chris mentioned, we'll be discussing MYSLs, multi-year single-line solutions today. And my colleagues have previously presented on parametric solutions. So where are we today? And, there's a lot of challenges out there. We've got COVID, and disruptions from COVID are likely to continue for some time. This certainly doesn't help our clients. And there is a difficult market environment right now. Continued losses over many years. Insureds are often facing, some combination of increased rates, increased deductibles, or lower availability of capacity. Hopefully the solution we're going to talk about today will address some of those issues. And also, in today's environment, Nat Cat losses are not slowing down. We see, an increase in frequency, especially for named windstorm and severity, and we expect this trend to continue. So the takeaway here is there's definitely a difficult market environment, and so I will discuss today on how a MYSL can benefit. So our definition of MYSL, it's a multi-year single-line solution. So it has a very interesting or cool acronym there of MYSL. And really what a MYSL does is it allows clients to purchase significant Nat Cat peril limits on a non-cancelable contract at a guaranteed rate over a multi-year term. So that's a lot, but really, what we find is clients are very interested in the non-cancelable aspect and the fact that it's a guaranteed rate. So a MYSL is really a Nat Cat carve-out. So as I go through and explain the MYSL product, we're going to talk about buyer motivation. We're going to talk about structure. We're going to talk about some of Swiss Re's, internal criteria for MYSLs. But every time we look at a new MYSL opportunity, we always ask, what is the buyer motivation? We want to make sure that we're starting out on the right solution for the client. So if we hear from a client that they're looking to reduce year-over-year pricing volatility, or if they're really looking for increased coverage and capacity certainty, these are all things that we like to hear. Also, a MYSL really can help stabilize earnings and balance sheet against Nat Cat exposures. So when we hear these things from clients, we know that we're on the right track for a MYSL solution. One thing that we want to avoid is where a client's motivation is price savings. If the motivation is price savings, usually a MYSL will not work. MYSLs are not cheaper than how a Nat Cat peril would be priced in a traditional product. But what this MYSL product is going to do, it's going to carve out a Nat Cat layer and will offer coverage on a multi-year term at a guaranteed rate. So it's really, the coverage you need. Now, we'll go a little bit into the MYSL structure. I mentioned it's a Nat Cat carve-out. Again, the definition, multi-year single line. So we usually look to carve out an individual peril from the traditional property policy. So lines of business that we look at, the two that have been most popular, that we've transacted the most on, are either named windstorm or earthquake. We've also transacted on a convective storm missile. We could certainly consider hail, and we have done them for flood, but flood is a little more challenging. It's harder to model, and so we certainly, we certainly find flood to be a little more challenging, a little less desirable. So again, we've had the most success with named windstorm and earthquake. Now, these deals, they're multi-year. They're going to cover multiple years. 3-year deals have probably been the most common from what we've done, but of course, other terms could be considered. And so a frequent question we get on MYSL structures are, well, if the term is 3 years, how is the premium paid? And we do not require all 3 years to be paid up front. What we would do is we'd collect 1 year of premium at a time. So if it was a 3-year deal, the client would make 3 annual payments. That's certainly a lot easier than coming up with 3 years at once. And again, one of the key features of this deal is, the terms and conditions are fixed and they're non-cancelable. So really to sum it up, it's a multi-year commitment to large Nat Cat capacity at a fixed rate over the term. And I keep emphasizing rate. So we come up with a rate that's based on the exposures that the client has, at the inception of the policy. And so if the client's exposures increased by 10% from year 1 to year 2, the year 2 premium would go up by 10% over the year 1 premium. But again, it's going to be at the same rate that we saw for year 1. And also, if the client's exposures went down by 5% in year 2, then in year 2, the premium would go down by 5%. Again, we're at the same rate. So that covers a little bit of the structure, and I'll just check. So next, let's look at some of these treaty features. What makes this a MYSL? So we're going to have occurrence limits. We're going to have annual aggregate limits and term aggregate limits over the policy period. This is what gives the MYSL its structure. And the occurrence limit, the annual aggregate limit, and the term aggregate limit are all predefined up front. For named windstorm, we usually look to provide 2 occurrence limits over the policy term. And again, those are guaranteed limits. And for earthquake, usually we set the term aggregate limit equal to the occurrence limit. The reason being earthquake being much less frequent. So if a large event ever does occur, we want to learn what we can from that, and we can always structure the MYSL to include, perhaps a prepaid reinstatement if one limit really seems to be not enough for the client. So those are some of the structural features that we have for the limits. And because the MYSL layer is a carve-out, it still needs to be in sync with the traditional property policy, both above and below in the tower. And it's always important to consider this because certain perils like earthquake are aggregated. And so therefore, the MYSL layer could drop down upon erosion of the underlying. So you can see it's very important for the MYSL layer to be in sync with the traditional property tower. And of course, the MYSL policy will reference the traditional property policy. Here's some other treaty features that can be added. We can add in a term aggregate deductible to reduce the cost. It's all dependent on, I guess, the client's needs. These structures are bespoke or tailored to the client's needs. And so therefore, we can add in a bunch of treaty features. Another one that we can add is a reinstatement. It can either be included in the upfront price or perhaps an additional payment as an option that the insured has. And we've even done these with no claims bonuses. And so we can get pretty creative here. Again, I want to emphasize these are really structured to the client's needs. And so, again, we start with motivation. We want to figure out what the client is looking for, what issues they have, and how we can help. Because at the end of the day, we are really looking for a win-win type solution. We want the client to feel good about this purchase. They would obviously be looking for something like this, really to stabilize, the rate over a multi-year term, or to lock in, guaranteed capacity over a multi-year term. And of course, Swiss Re has got to feel good about deploying the capacity as well. Also another thing to think about the limits that we provide. Some would say, well, why not just purchase on an annual basis? Because if you did that, perhaps you would get 3 limits over 3 years. But do remember, the limits that we're offering are guaranteed capacity. So if a client has a loss in year 1, and perhaps we're offering 2 limits over the 3-year term for named windstorm, they still have that guaranteed capacity for that additional limit in years 2 and 3. And that may not be the case if they're renewing on an annual basis. Perhaps they have a loss in year 1 on their traditional policy, and then they might have trouble finding capacity in year 2 or year 3. And that's not the case with the MYSL, because we are offering guaranteed capacity. Now, while we're talking about structure and treaty features, I'll go into a little bit about what we look for internally and the Swiss Re appetite. So our team, the Innovative Risk Solutions team, we're charged with the structuring, and we work hand in hand with our property underwriters. So it's their capacity. So we need to make sure that they would have appetite for deploying additional capacity for the client, for the peril that the client would want to carve out. Things that we look for, things that we consider are, do we want to tie up capacity over a multi-year period? We've discussed this internally, and we're happy to have a certain percentage of our portfolio where capacity is deployed over a multi-year period. But it's all about managing our aggregates. We're constantly looking at that. So it is something we want to, consider. How much capacity we want to deploy. Carving out has to make sense to us because we don't want to be adversely selected against. And some of the things that we look for, it would involve a full property submission. And of course, high transparency and, detailed protection and engineering information, really help improve the confidence that we'd have in carving out the peril. So that's a little bit about how we do things internally. Obviously, there are cases where we've been approached saying, would we do a MYSL for a client where we already deploy capacity on a traditional basis? And, that's something we have to think hard about because, the good news is, of course, yes, we know the client, we like the client, we already deploy capacity. But then we need to also consider, do we want to deploy more capacity, for that same tower? And so we'd look to see where we want to play and do we want to deploy more capacity. So when we consider whether we should deploy a MYSL, we would consider the aggregate amount of capacity that we'd be deploying for that client, both on a traditional basis and on a MYSL basis. But we certainly have done that before. We've participated on a traditional basis and on a MYSL basis for the same client. So that's a little bit about the structure and the treaty features. We've talked about motivation. So at this point, we're going to dive into some examples, some case studies, and hopefully these case studies will show you how a MYSL would work in conjunction with the rest of the tower. And so here's case study 1. I'm titling this, A MYSL Structure at the Top of the Insurance Tower. So here's the background and the challenge. So ABC Company, they've historically purchased $100 million of earthquake limit in their traditional property policy. So ABC is saying, look, we'd like to purchase an additional $25 million of earthquake limit at the top of the tower, and that would be in excess of the $100 million. However, they say budgeting for the cost of the 25x $100 million layer for earthquake is challenging due to year-over-year price volatility. So, this is great motivation for a MYSL. The client's concerned about price volatility. They're looking for a $25 million limit in addition to what they already buy. And so our diagram shows in pink the $25 million limit in excess of the 100 excess of local deductibles. That's the additional limit, additional earthquake limit that ABC would like to purchase. One of the things, as I said, that's kept them from deploying more capacity in the past or purchasing more capacity is the price volatility. And then the blue box underneath the red, well, that's their traditional property tower where they already purchased $100 million in earthquake limit. So this slide here sets up the MYSL structure or the need, the background, the challenge, and this slide is the solution, the benefit. So here the solution would be that ABC Company would purchase a $25 million MYSL layer for earthquake in excess of the $100 million of earthquake limit on their traditional property policy, and they would do it over a 3-year term. Here are the benefits. Guaranteed capacity over that 3-year term at a guaranteed rate. And And so this is obviously going to reduce the year-over-year price volatility. That's exactly what our client's looking for. And so now when we think about that diagram, we have that $25 million MYSL layer in red above the blue traditional towers. And there we have specified that there be a $25 million per occurrence limit, $25 million annual aggregate limit, and a $25 million term aggregate limit. And so you can see that that MYSL layer attaches excess of ABC's traditional property policy, which is in blue. And, you know, the MYSL layer is going to reference the traditional property policy. And so if the client was hit with an earthquake loss in year one, and let's say the earthquake loss was $50 million to the traditional tower, well, everything excess of the 50 that was eroded would all drop down. So then in year one, if there was another loss, Swiss Re would be, the MYSL layer would be $25 million in excess of the 50 because 50 had already been eroded for year one. And then if no other MYSL losses occurred in year one, well, then for year two, the MYSL layer would again be attaching at $25 million excess of the $100 million of earthquake limit that we find on the traditional property. So, good case study for a client that's looking to purchase additional coverage in excess of what they already buy. And again, this client is getting guaranteed rate, which is going to reduce their year-over-year pricing volatility. So, this is a quote I like to share before moving on to the next case study. One CFO that we dealt with said, "Look, I don't have all my debt maturing in one single year. So why do I have all my Nat Cat insurance capacity maturing in the same year?" Then that CFO went on to say, "Look, the Nat Cat portion of my property tower is the most volatile. So therefore, it is exposed to year-over-year price fluctuations. And that makes it very difficult to budget for. Is there a way we could purchase Nat Cat capacity over a multi-year term?" And so to me, this is a CFO that's really looking out for the risk management of their corporation. We think further conversations with that CFO produced a MYSL that we executed on, and we considered that a win-win for both parties. And also that CFO went on to say that they were very impressed with Swiss Re's innovative and structuring capabilities, and they said next time they need a innovative solution, they were coming back to us. So again, we can see how these win-win solutions are quite powerful. So we will move on now to a second case study. And this is for the client that's really looking for a MYSL structure as a hedging option. So now we have XYZ Company, and they have historically purchased $150 million of named windstorm limit on their traditional property policy. However, XYZ is not looking, they're not looking to purchase additional limit, but they would like to carve out a layer, actually 50% of the layer, 50x 100 million, and carve it out and write it on a MYSL basis. And we can see that in pink in the diagram below. So they currently purchase 150 million, but they're saying, look, I'd like to do a portion of the 50x 100 million layer on a multi-year basis. Therefore, they've really set up that 50x 100 layer as a nice hedging option for them. That way, they have half of that layer renewing on a multi-year basis. So they've locked in the rate over a 3-year term. Therefore, if rates go up, they benefit by already having a portion of that layer locked in. Now, they also would have 25 million part of 50, excess of 100, renewing still on an annual basis. Therefore, if prices soften, they can take advantage of that there. So really, this is a client that's really looking to hedge a layer, and therefore they're not exposed to fluctuations in the marketplace for a given layer. So again, XYZ, not looking to purchase additional capacity, just looking to redeploy some of their capacity on a multi-year basis that they already purchase. So now here's the solution, the benefit. XYZ company would buy 25 part of 50, a 25 part of 50 MYSL layer for named windstorm, excess of 100 million named windstorm limit in their traditional property policy over a 3-year term. So some of the benefits, they get a portion of that layer on a 3-year term, guaranteed rate. They reduce their year-over-year volatility. It's exactly what the client's looking for. Now, a portion of that layer is still protected, is now protected from rate increases because they're doing it on a multi-year basis, while the traditional portion of the layer still allows the client to take advantage of rate decreases in future years. So this structure is a little more tricky to depict visually, but I think I've accomplished that by showing the MYSL layer in pink. It's always going to be 25 part of 50, excess 100. And those MYSL limits would contemplate 25 million occurrence limit, 25 million annual aggregate, but 50 million term aggregate over the 3 years for this MYSL solution for named windstorm. Again, this is going to reference, the MYSL policy will reference the traditional policy, so it will be in sync with the rest of the tower. Again, the client has, what they've done here is they've accomplished exactly what they've set out to do. They've hedged a portion of their layer so they can take advantage of price decreases as well as, insulate themselves from rate increases for that layer. So it's a very interesting way of transacting. And in fact, we've transacted with a client that took it one step further. So for the pink MYSL layer, they actually transact with 3 different clients in that MYSL layer. So half of their layer, 50x100, would be on a traditional basis, but the other half would involve 3 separate insurance carriers, and all 3 renew on a different anniversary date. So maybe insurance company 1, provided a 3-year deal in 2018. Insurance company 2 provided a MYSL layer in 2019, and then the third insurance company provided a MYSL layer in 2020. And that really allowed the client to always have the latest terms and conditions at their disposal. So, when the renewal came up for the MYSL in 2020, they kind of knew what the market would bear from the previous year, and then they could factor in whatever happened in the latest year, as opposed to having to go back to the last MYSL that was negotiated 3 years ago, and then perhaps start fresh, renegotiating. So we've seen clients, use a MYSL for hedging in very interesting ways, and that probably answers one of your questions. Do we need to take 100% of a MYSL layer? the answer is no. We can certainly take a share of a MYSL layer. We're happy to syndicate, with other insurance companies for a large layer, because really our starting point is probably a limit up to $25 million in guaranteed Nat Cat capacity. We've done more for the right limit or for the right opportunity, but $25 million is a nice limit and a decent chunk of capacity to be doing on a MYSL basis. So oftentimes we might get requests saying, "Hey, can you do $100 million on a MYSL basis?" The answer is usually no for that one. Perhaps $25 million is a good place to start. And if the client was looking for perhaps $50 million on a MYSL basis, we would have no objection to having multiple insurance companies providing capacity, and therefore perhaps limiting the Swiss Re capacity to $25 million or less. So hopefully I've provided enough background here to tell you a little bit about motivation and the structure and some of the internal considerations that Swiss Re looks for when we consider MYSL opportunities. And then I've provided 2 case studies that really, I hope, hopefully ties all that together. And so I thought I'd end with a quote before we start going into questions. And really, the MYSL solution can really help our clients purchase significant Nat Cat peril limits on a non-cancelable contract at a guaranteed rate over a multi-year term. That's what our MYSL solution does, and I'll provide you now with our. Oh, sorry. We're over to our team slide now. We're currently a team of 5 in North America, and we all report into Bob Nusslein, and we have representatives on the East Coast, the West Coast, and it looks like I need a pin in Toronto as well. So we cover North America, and we're part of a larger global group, and we have teams in Latin America, in the EMEA region, and the APAC region. Again, our goal, provide bespoke solutions to our clients. So, Chris, can we start with the questions?
Yeah, absolutely. Thank you so much for that, Todd. Let's get into a few. I think we received a number of questions asked throughout the presentation that you addressed. There was a lot of interest in capacity deployment from Swiss Re, which you said, $25 million is a good starting point. Maybe we could stretch beyond that. But if it gets much higher, we would look to share with other insurers. Why don't we get into a question about can MYSLs be utilized to replace the earthquake coverage in the main property policy? So in other words, you take the earthquake coverage from, carve out earthquake coverage from the traditional policy and rely on a MYSL, kind of envision 100% participation in that program.
We have done MYSLs where we attach excess of deductibles. But again, I would start always with what is the motivation? Why are they looking to carve out the earthquake from the traditional property? And so there's a number of considerations that we would think about. Number one, how much limit are they looking for? Is it that they're really looking for that stability? Hopefully price is not the reason they're looking to do it, because as I said before, we've determined that price is not a solid motivation for seeking a MYSL solution. But if the client is just purchasing $25 million, perhaps that would be a solution. But I haven't seen too many cases where that would be a good fit. So I'm not saying no, but I would certainly want to drill down more into the opportunity because I could see it going a number of different ways depending on the client's motivation.
Thanks for that, Todd. Next question is, what underwriting information is needed for a MYSL?
Yeah, so usually we start with the same information that our underwriters would receive for the traditional property policy. We're going to work hand in hand with the underwriting team. Oftentimes, they've already looked at the traditional property tower for that client, and so perhaps the MYSL opportunity comes out of that. And we really do like those opportunities because, first of all, we already have the information. It's the complete underwriting submission. Our underwriter is already familiar with the client, so they know where they'd like to attach. They know how much capacity they would like to deploy, if they'd like to still participate on the traditional and deploy more for the Nat Cat carve out for the MYSL. So, but we really want high transparency. Of course, that's detailed protection and engineering info, because the higher the transparency, it's really going to improve our confidence in the risk that we're looking at, and that's going to, when our confidence goes up, that really allows us, it really bodes well for the success of a carve-out.
Todd, next question. If the insured's exposures increase in year 2 from year 1, would the annual premium for year 2 also increase?
Yes. So we build that into the contract. The rate is set and guaranteed. And so the MYSL contract would list the exposures at the inception date. And then we just use a formula to adjust the premiums for years 2 and 3 based on changes in exposures. So if exposures went up by 10% in year 2, then the premium would go up by 10% in year 2 over year 1. So, and that's all consistent with having a guaranteed rate. And I emphasize again that we can structure these so that if the client's exposures went down by 10% in year 2, then the premium also goes down in year 2. And that's a very important consideration for clients that are taking on additional exposures or perhaps reducing exposures on a year-over-year basis, because a client like that might shy away from a multi-year deal if they were planning on reducing exposures in future years. But our MYSL product will take that into account. It's all going to be spelled out in the policy, and we make it very simple. It's just, if exposures change by X amount, then the premium changes by X amount in that year.
Todd, a couple of similar questions came in that are related to what you just addressed there, and likely given the current market environment. So let's get to this next question. What happens if the underlying structure or deductible changes in subsequent years? How does the MYSL react to that?
Yeah, good question, because this the MYSL would have to dovetail. It has to be in sync with with the rest of the tower. And so in that case, we would just use all commercially available, efforts to get the missile realigned with the traditional tower. And with that, we would rely heavily on our underwriting team. Because if changes are going to occur in the traditional tower, we're going to work hand in hand with them to make sure that we can keep this missile, to see if we can make the changes necessary to the missile to keep it linked in and in sync with the traditional tower. That's a pretty remote situation. We haven't really experienced it that much, so I don't have any examples off the top of my head to reference, but we would use all commercially available efforts to make it right.
Thanks, Todd. Can this cover be offered globally, or is it U.S. only?
Yeah, we have. There are times when our clients do have international exposures, but really, our team is looking to cover, clients based in the U.S. or Canada, and so the majority of the exposures should be located here. If there are international exposures, that's going to that would require some more thought, because normally what we look at are exposures either in the U.S. or perhaps Canada. So international exposures, what we do there is we would go to our underwriting team and determine the best course of action. But kind of the rule of thumb with all of these structured solutions is the more complicated you make them, the harder it is for us to execute on them. So we're not looking to carve out something and make it super complicated. The easier solution would be, to carve out perhaps, our wind exposure in the United States on a missile basis. That would have a much higher chance of success than trying to do something with international exposures.
Next question. What are some types of clients or industry groups who purchase missiles? Examples, please.
Yeah. So sometimes we have clients that have large concentrations in Nat Cat areas, such as exposed to hurricanes in Florida, or maybe they have a lot of assets in California or the Pacific Northwest. And so those are the clients that are perhaps worried about year-to-year fluctuation in price. So we've had success where we say, look, we'll carve out your California earthquake exposure and write it on a multi-year basis. Or we will carve out your Florida wind exposure and write it on a multi-year basis. So that's a client that's looking at a very targeted exposure. By carving it out, they can get the guaranteed capacity that they want, and they get it at a locked-in, at a guaranteed rate. Because if you think about it, sometimes our clients might say, look, these earthquake exposures that we have in California are really a challenge every year for us when we go to renew our traditional property tower. And so carving them out and writing them on a multi-year basis would resolve a lot of headaches on a year-to-year basis. That way we have the capacity, it's locked in, and we don't have to worry about what the market will bear in years 2 or 3. So really, it's the client that's looking that has that asset class in a Nat Cat prone area.
Todd, on the topic of buyer profiles and industry sectors, there's a question about construction. Could a MYSL sit over a rolling builder's risk course of construction insurance program?
So, you know, a MYSL is a Nat Cat carve-out, and so we're really carving out something. And I haven't seen it carved out from a builder's risk program, so I'm guessing that perhaps our MYSL solution wouldn't be the right solution. I mean, never say never, but really what we would do there is we'd start probing and start trying to find out why the client was looking to carve out capacity over a multi-year basis. And perhaps, you know, the client's need is there, but maybe the solution wouldn't be a MYSL solution. Maybe they're looking for something else, like a parametric solution that we've discussed in previous in previous webinars. So I wouldn't say no specifically without knowing more about the opportunity. But again, a MYSL is really meant to be a Nat Cat carve-out. So I'm guessing that it's not part of that builder's risk. And if it was to be carved out, why would you be looking to carve it out? Because I'm guessing that the builder's risk is over a multi-year term or for a guaranteed length of time while something is being built. And
Thanks,
Chris,
Todd.
I want to follow up on the previous question because you asked about. I don't think I answered it completely because you talked about who might a MYSL benefit, and we've actually seen the MYSLs benefit our public entity clients quite a bit. These are clients that would really benefit from you know, a guaranteed rate over a multi-year term. You know, think about municipalities in highly exposed Nat Cat areas, like you know, somewhere on the West Coast, or for earthquake, or in highly exposed wind-prone areas. So those are also clients that we think about as being a good fit for the MYSL solution.
Oh, thanks for that. Thanks for that, Todd. We have the next question is sort of a mini case study, if you will.
Nice. Yeah.
If a client has 750 million TIV, but only carries 100 million in earthquake cover, is this a good solution for them to have additional earthquake limits, say 100 million excess those primary 100 million in earthquake limits?
Yeah, that would be a good discussion to have, where the risk manager, the broker, and the insurance company all sat down and maybe brainstormed there, because there might be a reason why they're only buying 150 million in limit at this time. Maybe that's all they think they need, but you know, maybe more has been available in the past, but perhaps they didn't like the price volatility for limits above 50 million. So there's more that we would need to know. You know, is the capacity available above 150 million? You know, would our underwriters be interested in providing that? But it does sound like something similar to the case study number one, where the client wanted to buy more, but but didn't purchase more limit due to the price volatility. And so if that was the case, perhaps additional limits could be available there. But again, I think we would need to know more. We definitely would want to see, where their exposures were. Are the full 750 million of TIV, or all of those exposed to earthquake? So definitely worth drilling down on this. And so therefore, we find that our chances of transacting really go up once we get that three-way dialogue involved with the insurance company, the broker, and the client. Everybody brings something to the table there. We can all brainstorm, and oftentimes that initial three-way conversation produces a higher chance of a successful outcome because we're able to brainstorm. And this would be a perfect situation, where a client came to us or a broker came to us and said, here's the situation. Would a MYSL be a good fit? So obviously there's a lot of layers to this one. We'd want to drill down. We want to probe, ask a bunch of questions, bring in our internal experts, such as our Nat Cat team and our underwriter, and get the full power of Swiss Re and of course the broker and the client behind this, and then look to kind of see if there's an intersection between client need and what we can provide, and then if so, we hopefully find a solution.
Thanks, Todd. We had a question come in about how do lenders view this product? And I'm wondering if you have a perspective on that or experience with that. I'm assuming this is kind of derives out of loan agreements and various insurance requirements contained therein. So do we have experience or a perspective on how lenders view MYSLs, Todd?
I think a lender would see this as Nat Cat coverage. It's just a carve out. So when we look at the motivation of our client, we don't list lenders in there because we haven't run into this as an issue in the past. So if lenders are requiring a certain amount of limit to us, or I should say to the lender, it shouldn't matter if the capacity is coming on a traditional basis or on a MYSL basis, because the MYSL is guaranteed capacity. Now, if with a MYSL deal, we do provide, we do look at annual aggregate limits and term aggregate limits. We can put a reinstatement in there. There's a lot of things that can be negotiated, but there is the possibility that over the 3-year MYSL term, that the limit could be fully deployed, and the client would be bare in that layer. And I could see that might cause some issues with a lender. And so in that case, perhaps the lender would require that the MYSL contained a reinstatement at the client's option in there, and that would provide another limit, or perhaps perhaps there's some other elegant solution. But in summary, this is just a Nat Cat carve out, and so we're deploying capacity.
Todd, thanks so much for that. That wraps up Q&A. That's all the time we have for today. And I want to thank the audience for joining us today. You're fantastic. And for our speaker, Todd Chima, for leading us through MYSL Solutions. We'll send out a copy of the recording in the coming days in case you want to listen to it again or pass it along to colleagues. You'll see that I've put up a poll to get your feedback on your thoughts around the quality of this webinar as part of our webinar series. And of course, we'd be happy to continue the conversation with you. Feel free to reach out to Todd or me or any Swiss Re contact that you're in touch with. And finally, we hope you could attend our upcoming webinars. Next up is a look at our recent Sigma study on de-risking the global supply chain. That will take place on October 13th. That's next week. And then following that, we'll look at NDBI case studies, non-damage business interruption, on October 21st. So we've covered that topic in a previous webinar, and we're going to dive much deeper into case studies to kind of expand understanding and use cases for that. Please stay tuned for invites for those events, and keep an eye on the Swiss Re Corporate Solutions LinkedIn account. Enjoy the rest of your day, and thanks so much again.